Okay, guys, we are back with session two. Sorry, this will be page 443. One of my favorite sections on progressive exposure, a concept that a lot of people do have a tough time understanding. But this section will last about an hour and 15 minutes. We will take a 5-minute break after this is over as well. So let's get back right to it with Mark and Mark.
Okay, welcome back. Day 4, 2022 Master Trader Program. We're in the second workbook. We're now moving to page number 469. A lot of pages we went through. We're going to talk about position sizing now, which, as I said earlier, is one of the most often or most popular topics that I get asked questions on. I keep it pretty simple with position sizing, and there's definitely, you have to make the determination on your own as far as what your risk tolerance is, and then that is going to it's dynamic. It's a moving target because, as we said before, when we're first getting into the market, we don't have any profits, and maybe we're in a bear market and we're not sure if the market has turned into a better environment. We're keeping the position sizing smaller, and we're only going to move it up when we're getting that traction. But there are some general rules of thumb. All right. And I want to go over those, and then I'm going to show you what it all boils down to and what you really have to pay close attention to, and what rules the day, if you will. So first of all, as I said, 8% is my maximum stop, 10 to 12 staggered. If I have a 4 and a 12, that's 16% divided by the two half positions. It would still give me that 8% loss. So that's my outsized losses are going to be, regardless of the position size. That's it. That I'm never going larger than that. There's a hard line in the sand there. Like, there's no questions asked. And I'll tell you, this is where this one-time moment that I talked about earlier rears its head, because I've rarely seen Mark Ritchie and a few traders that I've worked with and trained and so forth, that I've seen that are religious, that there is no bending this rule. People bend this rule. They bend this rule. And the problem is they bend it at the worst possible time. Mark, you didn't talk about it in this Master Trader Program yet, but we've talked about it many times about how trades and success, and even the times where the market's bad, comes in bunches. And that's one of the things that you have to be real careful, because when the losses get big and they balloon, sometimes it's at the worst possible time, when you have this one-time moment, and you get into these trending periods where you get a lot of losses in a row. So now you've got a lot of losses, and you got big losses. I mean, as far as, I don't know, can you talk a little bit about your own anecdotal evidence and what we've talked about with trades, how they come in bunches, and that this isn't just where you get, if you have a 50% batting average, it happens back and forth, back and forth. We can go long periods of time, right, where you're getting stopped.
Absolutely. And you should make another, note in your notebook to say, that the wins and losses are not evenly distributed. And what that means is, if you think of it in terms of a coin flip, if you say it's 50-50, most people think that means it's heads, tails, or heads, tails, tails. And the reality is, the runs of wins and losses can be very chunky in there. And the biggest mistake people make is, say they have 3 or 4 losses in a row, and they think, well, I got to have a winner, so they trade bigger. And that's precisely, the opposite of what you want to do. I've shared this, I think, before at the Master Trader Program, or at least on the platform a time or two. I have a friend who is a PhD in statistics, and he was visiting my office one day, and I was explaining to him what I do, and he was actually saying, well, that makes exact sense why you do things the way you do, because he said they used to have these experiments where students would have to come up with a random generators of heads and tails, a 50-50 distribution, say 200 times. And the professors would be able to pick out which ones that the computer made and which ones the students made, because a human automatically thinks it's gonna be very orderly. They don't put 10 heads in a row or 10 tails in a row in their distribution. But in random,
Right.
in nature, that is what actually winds up happening all the time. And I've had periods where I think I've lost 15, 20 in a row. That just tells you right there, you're going to have those periods. So you have to continue to sit there and cut those losses off by trading smaller. And the position sizing, is really where everything is. This is where it all comes out in terms of the risk management and position sizing working together to make sure that if you're going to have 15 or 20 losers, you're also going to have 15 or 20 winners. You want to use that to your advantage on both sides of the distribution curve.
And you just made the argument for progressive exposure also, what we
course.
previously talked about. And so what Mark's talking about, the flipping the coin, also, I actually have studied a lot of different, I was always fascinated with probabilities. Even when I was a little kid, for some reason, I was always fascinated with probabilities. I studied the roulette wheel. I was so curious to see how long, because they have these the fallacy of being able to, if it goes X amount of times on black, you play red. Well, theoretically, it can go on black for your entire lifetime. But the law of averages say that that ball will bounce around, and it'll be only so long that it can go in any one color. I've seen the roulette wheel with my own eyes, watching spins in the roulette wheel in Vegas or Atlantic City. I've tracked them where it went over 40 times. For a 50-50 distribution, went red, black, evenly distributed over 40 times on one color. So again, and that's about as near perfect of a distribution as you can get. A flip of a coin or a roulette wheel, that's about as, the law of averages, that's what you can count on them pretty much as anything there. Trading, there is nothing that says that it has to. There isn't no 50-50. The odds.
So just putting that in layman's terms, Mark, the idea is who can survive 40 losses in a row trading larger.
Or trading the same. Forget about trading larger.
Great point. Trading larger is impossible, right?
Right.
Trading the same is going to put you in a drawdown that is way too big.
Death by 1,000 cuts, you could still blow up. So just because you keep your losses small does not mean that you can't blow up your account or you can't take a large drawdown. You can. That's why position sizing still has to be, and all this has to be used with progressive exposure. It all works together. Everything works together, and it all supports each other. But as Mark just said, on the opposite side, that's how you create that opportunity and that leverage. So now your average loss, your max loss is 8%, 10-12 staggered, but that's not what you should be averaging. You should be averaging less, because it has to be less than your max, because you're going to have losses that are smaller. So your average loss should be no more than 5-6% if your largest is 8%. Another general rule is that you never want to take a position. I mean, really, 25% is probably the biggest position you should ever take. I've taken, certainly intraday, I've taken gigantic positions. I've gone 4x leverage in one name, but not overnight. But overnight, 50% would be an astronomical position size. Now, again, depending on where you are, maybe in your life cycle, as far as if you're just starting out. When I first started out, I had a few $1,000s. Yes, it was all the money in the world to me. So if I put the whole thing in a stock and it imploded, I would lose everything. But I could also go work a job and save a couple $1,000s. Now, if I put my whole net worth into a stock and it blew up, it would take me 40 years maybe to get it back. It would take me decades to get back to where I am. So again, if you're taking, if you have smaller dollar amounts, yes, maybe you're going to be more aggressive. But generally speaking, stocks can go down. You can have a gap. Like I said earlier, Future Healthcare, I saw it go down 80% on a gap. We've just seen, there's been lots of gaps that have been down 50% just in this recent decline. So if you were to have a 50% position size, and even if stock went down 50%, you take a 25% loss. That's huge. For me, that would be, colossal. But it is recoverable. 25% to 25% is what I personally shoot for optimal position sizing. If you were to go and use the Kelly formula or optimal F, and these are formulas that will, if you know your gain, your loss, your batting average, if you have that information, it will give you your optimal position size, where any other position size, more or less, will be worse. And a 2-to-1 trader, your optimal position size is 25%. I just happen to anecdotally figure that out. And before I even knew about the Kelly formula, before I knew about optimal F, before I even did the math in my trading, I just traded so many trades and learned from experience that I found that 25% position size was the sort of the sweet spot for me. So that's what I shoot for. That's what you should be shooting for. But you don't get there right away. Progressive exposure, you have to work your way and then get to where maybe you have 5, 6, 8 stocks. You're going to have some half positions, some quarter positions. When it's all said and done, you've got a portfolio of 8, 10, 12 stocks. Maybe if you have a really big portfolio of 16 names, certainly no more than 15 or 20 names. And you want to shoot for having 4 or 5 big positions. And that's where when you make some headway, you're going to make some big money because you've got concentration and position size. And now when you bring your overall exposure up, now you can make a real gain. Now you don't want to be afraid of big position size as long as things are working, stocks are working, and you've got a plan to mitigate your risk. You do want to get to big position size, but you should be afraid of them if you're just coming from cash and you've got all risk. You've got no cushion. You got no evidence that the trades are working. Yes, that's when you want to be very respectful, of those position sizes, and you don't want to get big position size. You want to grow into those big position sizes, as we said. Now, the real key is your risk of total equity. This is what sort of it all boils down to. This is the real important number: risk of total equity. So if you take a 12.5% position, let's say that's a half position of your full position is a 25%. So a half position would be 12.5%. If you were to risk 10%, you had a 10% stop on that 12.5% position. Well, that would be 1.25% of total equity, right? You have a $100,000 account. You take a 12.5% position. That's 12,500. 12,500 times 10% is $1,250. That's your risk of total equity. That risk of total equity, and again, this isn't an opinion. This is math based on and again, I'm trying to remember who did a study on this. What's it? The older gentleman, commodity. Your friend, Mark.
Peter Brandt.
Peter Brandt, yeah. Peter Brandt did a great article on this. I don't know if it was a public article. I can't remember, but I was privy to it. And it made the argument for, like, once you got over that 2.5% risk of total equity, your risk of ruin really increased. It ballooned dramatically. The risk of ruin is how many trades it would take for you to blow yourself up. And once you go above 1 to 2%, 2.5% would be a 25% position size. 10% stop would be 2.5%. 2.5%, you should never be at 2.5% unless you are experienced. You've got cushion. Things are working really well. Then you can move up to maybe 2.5% of total equity, but that would be the absolute max. You should be around 1 to 1.5%. Now, you got to shoot for that optimal level, because if you're down at 0.25%, you're not taking enough risk. And now you can be right and you can trade and trade and trade, and you're never making any money because you're not taking enough risk. So there is an optimal amount of risk. And that optimal amount of risk that I found, and through math, is around 1.5%, call it 1.25%. So now if you were to take that big 50% position, here's the key. The key is that your position sizing is tethered to your stop to get to risk of total equity. So now if you were to take that 12.5% position, you could take a 10% stop and you would have 1.25% risk of total equity. But now you bump that position to 25%. Well, you can't take that 10% stop anymore, because now 10% of 25 is 2.5, too much risk. So now you have to bring your stop to 5%. And now you're at that 1.25. Double it to the big 50% position. Now you've got to back into a stop of 2.5% to have that same 1.25% of total equity. At the 5%, you're at 2.5. At the 10%, you're way, with too much risk. So that's the number that you want to back into, but you back into that number by you staying within these guidelines. All right. You don't come out of these guidelines. As long as you're staying within these guidelines, from there, you back into the 1.25, 1.5, 1%, right in that range, give or take. And that's where you want to optimally be. Let's see. I don't know, Mark, I don't know if you have any.
I was just going to add, it's interesting. You mentioned Peter Brandt, who has he's a directional trader, different style in terms of entries, but he doesn't use the language of progressive exposure. But if you read his most recent Marcus Wizards interview, and he does the exact same thing. He only takes big size when he's at or near new equity highs in his account. And when things are going against him, he gets really small. So he uses some of the same risk management principles. And to Mark's point, he never takes trades bigger, I think, than 1.5 to 2% of total equity.
Yeah, I don't know Peter Brandt personally. I know Mark does, and I have a lot of respect for him because he is a successful trader and an older gentleman that's been around for a long time in the markets and done well. So, like I said, all the great traders, all the champion traders, these are the things that guides them. This is really the holy grail. This whole risk management section, this is the holy grail. This is what makes the difference. Let me show you a couple things here. So again, I'm always looking at the math, okay? And with position sizing and your edge, it comes down to what is it gonna take to get to your goal, right? That's the main thing is getting to that goal, whether it's 100% this year or whatever that goal may be. It's all going to come down to math. So when we look at position sizing, again, if our position sizing is too small and we're not taking enough risk, well, then it might take us 5,000 trades to get to our goal. And we just can't simply get off 5,000 trades in the allotted amount of time, the allotted amount of time that we want to get to that goal. So the first thing I do is try to figure out, well, what's it going to take me to get to my goal at these numbers? So if you have, let's say your desired return is 40%, right? Call it for the year. We want to get, that's your goal. I want to make 40% a year. I'd be happy with that. Okay. So your position sizing 10%, your average gains 12, your average loss is 6, your batting average is 40%. It's going to take you 334 trades to get to that goal. So now the thing with position sizing that you have to remember is that it automatically, if you increase your position size, you increase your risk, you increase your potential proportionally, right? So now we increase our position size to 25%. We go from 10% to 25. Same exact numbers. Now it's going to take 134 trades, right? So a lot less work. And of course, if we can do that same 334 trades, well, now instead of 40%, we're going to get 100% return. So again, it all comes down to the math, and there's certain guidelines, and there's certain, like with the probability curve, there's that wall. We got to stay, that wall is defined by the right side. Losses are a function of expected gain. Position sizing, there's a certain amount that you're going to need to risk optimally, where too much risk is going to put you at risk of ruin, not enough risk. But then we've got to also, how many trades can you get off with your system? And again, this is where shorter term trading, swing trading, is what's been so powerful for me, because in any one year, if your strategy and you're buying from the same point, let's just say, Mark's buying from the VCP coming out of the base, but he's holding for the big moves, right? That's how he makes his returns. And he'll hold for big drawdowns because he's trying to get to that 100%, that 100, 200%, the 10 bagger. So you by default, you got to go through the pullbacks. Well, every year, you can't count on stocks doubling and tripling every year. There's going to be a lot of downtime there with drawdown and time where you're just not going to be able to put lay the return down. However, and if you need 334 trades, there's going to be a lot of trades that you need, and you have to have that available merchandise to be able to trade. Now, what I found is when you go down to where you only require, say, a 10 or 20% move, well, every stock goes up 10%. Every year, there's many stocks that go up, and I can squeeze a lot more trades into a time frame. So again, one trades off for the other. If you're going to have the shorter time frame, you're going to have to turn it over more. You're going to need more trades, and it's going to give you more opportunities, which we're going to talk about opportunity cost also in a little bit or later on. I think that's actually in mind-blowing math. So I want to wrap this up with a risk management section. I want to wrap this up. And basically, this is another question that I would usually ask when we did the in-person event. As a trader, right, which is the better deal? $1,000 guaranteed or $1 million with a 1% chance of losing it all? Right? Now, the operative word here, I'm going to give you the answer, of course, is as a trader. That's the real key is as a trader. Remember when I said if you were to cross the street and you close your eyes, right, and one guy runs across the street, closes his eyes, closes his ears, and makes it to the other side, the other guy looks real carefully, runs across the street and gets hit by a car. All right, well, one of them was very diligent and prudent and got hit and got killed by a car. The other one that, just haphazardly ran across and made it to the other side. But the bottom line is that trading is not a one-time event. You're going to trade many times. So the answer is if it was a one-time event, well, then the $1 million would be the answer. But if this were 1,000, an event where it was 1,000 times that this had to happen as a trader, it's going to happen over and over. Well, then a 1% chance of losing everything eventually has to happen. So you guaranteed go broke. You go broke, for sure. So $1,000 guaranteed will always win out in the long run. And the moral of the story is that you can't even allow not even a 1% chance of losing everything. When you position size, if you put it all on the line, if just it happens even 1% of the time, at some point you will blow up. If you take too much risk and there's too much risk of ruin, at some point you will hit that streak. As Mark said, those bunches, those 15, 20 losses are going to come. And you're going to eventually have, if you don't completely blow up, have a huge drawdown. That's going to negate all your progress, and you're going to end up being having a mediocre return. So that's why progressive exposure, position sizing, risk of total equity, all these things, timing the trade, stop losses, financing your risks, staggered stops, all these things put together, when you start to use them, it becomes incredibly powerful because you are creating asymmetric leverage. You're never risking too much, and you're exposing yourself to unlimited potential and levering up into that potential, always levering into the potential and always bringing your risk down when things aren't working. And that's really what this is all boiled down to. I don't know, Mark, did I miss anything as far as what this all boils down to, or is there anything that you could kind of put a explanation point on this, or
just to sum up, in terms of position sizing, risk management, this is the tip of the spear. It was funny, I think it was the first or second year, I remember a few people went, because this is normally toward the end of the seminar, and a number of people ducked out, just sort of figured, I got all the good stuff. And I remember just thinking these folks don't even have a chance. And just to sort of wrap things up, Mark mentioned earlier that we did a Real Vision interview together. Real Vision came to me earlier in the year and said, we want you to interview some people who inspired you or whatever. And they gave me a bunch of suggestions, and I said, I'm not interested in any of those folks. And so I gave them a list of 4 market wizards who I interviewed. And the one thing they all had in common, other than the fact that they've made millions and millions of dollars in the market, is they're all obsessed about risk management. Every single one of them, different strategies, but risk management is at the bedrock of how they've made their fortune and were successful.
Yeah, and in all fairness, going back, I remember when we had people ducking out during the risk management, but that was actually my fault because we scheduled it where the last flight was before we ended, and we never did that again. It was a time where we were in Myrtle Beach, and the last flight out was a lot of people were going to New York and certain places, and they had to catch the flight. But I remember that I was on stage going, did I say something wrong? But anyway, so we're going to take a break.
Okay, guys, so that is the section on position sizing. Obviously, Mark skipped the section on progressive exposure. We will get back to that in just a moment, but once Mark starts the recording, we can't stop him because of the buffering involved. So with that said, we're going to take a 15-minute break right now. When we do come back, Mark will go back and he will do progressive exposure on page 443, but we'll take a 15-minute break for right now. Get some food, do some push-ups, get the blood pumping. Exciting section is coming right up.